All right, if you own any silver, you need to stop what you're doing and listen. What's happening in China right now is a major red alert. The global silver market, it isn't just acting weird, it's literally fracturing right in front of us. And the evidence is it's impossible to ignore.
So let's get right into it, because this is the big mystery we have to unpack. While you and I see a silver spot price of, let's say, $75 an ounce, investors in China are paying the equivalent of over $150. Now that's not just some tiny premium. That is a sign of a market completely breaking in two. Why?
And this, right here, this just lays it all out. It's the core of the whole conflict. On one side, you've got the Western price, which, let's be honest, is mostly driven by paper contracts, futures, ETFs, basically claims on silver. But on the other side, you have the price in China, which is being driven by a frantic scramble for the actual physical metal. And these two prices, well, they can't live in the same world anymore.
To really get how serious this is, we got to look at the first domino that fell. I'm talking about the total lockdown of China's biggest and pretty much only pure silver investment fund, the UBS SDI Silver Fund. This wasn't just a market hiccup, okay? This felt like a deliberate, controlled shutdown. I mean, just look at how fast this all went down. It started back in December with these little daily warnings about a 12% premium. No big deal, right? Well, by late January, with that premium just exploding, regulators slammed the brakes and suspended all new investments. And then, on February 2nd, they dropped the bomb. They forced the fund to revalue its assets based on the much lower Western price.
And the result? It was an absolute catastrophe. The fund's value just cratered by almost a third in one day. We're talking about the biggest single-day drop in the entire history of Chinese public funds. This was not the market at work, people. This was a regulator stepping in to stop a panic, but probably not the kind of panic you're thinking of.
And that is the key takeaway here. You might read that this was about protecting investors from a little volatility. No, the data tells a completely different story. They shut the system down to stop a buying frenzy. A frenzy so insane it was about to expose a massive shortage of the actual silver behind the fund.
Think about this for a second. Before the regulators pulled the plug, investors were paying more than double what the fund's assets were actually worth. I mean, let that sink in. They were willing to pay $150 for what was essentially $75 worth of silver exposure. That's not speculation, folks. That's desperation. That's the kind of signal you see when a market thinks the physical supply is about to go to zero.
So you have to ask yourself, why would they shut down the buy? Why not just issue more shares of the fund to meet all that demand? Well, because this was never just about a fund. It was part of a much bigger, coordinated national strategy to hoard physical silver. This is a strategic material, vital for everything from solar panels to their military, and they decided to trap it all inside their borders.
And here's the proof. Look at the policy. On January 1st, just a few weeks before this whole fund crisis blew up, China quietly changed the rules. They reclassified silver as a strategic material and rolled out new export laws. Suddenly, only a tiny handful of companies, just 44, were allowed to ship silver out of the country. They basically just locked the doors from the inside.
So first, they lock the exits with those export bans. Then they shut down the main entrance by suspending their biggest silver fund. And what does all this create? It creates a totally fractured global market. We don't have one price for silver anymore. We have two. It's that simple.
This slide, right here, this is the key to understanding everything that's happening. In the West, we have the paper market. The price is just a derivative of a derivative. It's a claim on silver that, may or may not actually be there. But in the East, a whole new market is being born, one where the price is being set by a real physical scarcity, and the fact that you just can't get the metal from point A to point B anymore.
And you can actually measure this fracture. The price difference between Shanghai and New York has blown out to over 45%. That's a $76 gap for every single ounce. Now, in a normal, healthy market, traders would jump on that. They'd buy cheap in the West and sell for a huge profit in the East, and that gap would close in an instant. It's called arbitrage. But they can't do it. The metal is trapped.
And look, this isn't just a China story. The whole reason that arbitrage gap can't close is because the physical shortage is now a global problem. The world's vaults are being drained at a rate we have never seen before.
So let's look at the East first. Right before this whole crisis kicked off, the physical silver sitting in the Shanghai Futures Exchange vaults hit its lowest level in over a decade. The well was already running dry inside China's borders.
Now, look at the West. At the exact same time, the COMEX, which is our main metals exchange, saw more than a quarter of its registered deliverable silver just vanish from its vaults in 1 week. We're talking 33 million ounces. Poof, gone. So you see what's happening, right? This is the critical point. The East is running out of metal, and the West is bleeding metal. And when both ends of the system are being drained at the same time, and the metal can't flow between them, you don't have a market anymore. You have a system failure.
Okay, so we've laid out all the evidence for this fracture. Now let's bring it back home. What in the world does this unprecedented situation mean for you and for the silver that you're holding right now?
This is it. This is the single most important question you need to ask yourself. Because in a market that's broken like this, the difference between owning a paper claim versus owning the actual physical metal, well, it becomes the difference between taking a huge risk and owning a real asset.
Look, if you own an ETF or a futures contract, what you really own is a promise. It's an IOU from somebody else. And your biggest risk is that they can't deliver the metal and just decide to settle your contract in cash at the artificially low paper price. But if you own physical bullion, you own the asset itself. And in a crisis, its price isn't set by paper games, it's set by raw physical scarcity.
And this is probably how it's all going to play out. As those vaults keep getting emptier, you're going to start seeing delivery failures on the exchanges. The paper markets will be forced to cash settle, basically admitting, oops, sorry, we don't actually have the metal we promised you. And at that exact moment, the physical price is going to completely disconnect and skyrocket to its true value, a value that's probably a lot closer to what those Chinese investors were willing to pay.
So, what's the bottom line here? China's actions, the export bans, shutting down the funds, these are not bearish signs. They're the clearest signal you could possibly get that the physical shortage is real and it's here now. Think about it. You don't take these kinds of drastic steps when supply is everywhere. You do it when you know the warehouse is almost empty and you want to be the one holding the keys.